Hello and welcome to our MDOTM seminar today, where we want to talk about whether artificial intelligence can change the sub-advisory business. And Tommaso and I are very happy to welcome Michael Bowdens to the webinar today. Welcome, Michael.
Thank you, Axel. It's nice to be with you.
So Michael is a very distinguished guest for us. So he has been working in the asset management industry for more than 30 years and is now currently serving as on the board of trustees and as the chair of the investment committee of the University of Georgia Foundation. He is also a retired partner and vice chair of Wellington Management, and during his time at Wellington, he was instrumental in increasing and building out Wellington's sub-advisory business. So we really appreciate the knowledge you can bring to the discussion today. So, but before we go into detail, I think it makes sense to talk a little bit about the terminology to make sure we are all on the same page. And what we're going to cover today as more setting the scene is to show you how the sub-advisory business works, what are the components of it, what are the markets and the opportunities, what are the benefits of AI-driven investing, and then the core of the discussion today is going to be, can AI actually change that game? So for all our participants, and there are quite a few today, please feel free to ask questions in the Q&A section, and towards the end of our presentation, we're going to have another 15 to 20 minutes where we can address all of these questions. So sub-advisory, what's the terminology? So we have a sponsor usually, so that could be a bank, wealth manager, insurance company, who would set up a mutual fund under its own name. The sponsor would then ask a sub-advisor to actually do the portfolio management of the fund. The sponsor would then also use its distribution network to offer the fund to the end client, and that could be anybody who is interested in buying a mutual fund. So it could be a retail client, but it could also, of course, be an institutional client. So what makes that area so interesting for us? And this is just to provide you some size to share about the growth and actually importance of that market. So globally, we talk about a market size of approximately 6 trillion euros in assets. About half of that is managed by affiliate managers and the other half by unaffiliate managers. Alone in Europe, the growth rate of that market is expected to be 11.4% over the next several years. Part of the reason for that growth in Europe is, among other things, the MiFID II regulation, which, among other things, looks into how sponsors and sub-advisors are compensated. And so that boosted, again, the urge of the sponsors to use sub-advisors in managing their funds. There are about 1,000 sub-advisors. They manage roughly 7,500 different portfolios. So it is a very large market. It's a very growing market, so it's of a lot of interest. So this is just one side of the equation, why we want to talk about AI and sub-advisory. But if you look on the side of artificial intelligence, everything, of course, is very data-driven. So we live in a very complex world. And just to give you an idea about the scope of the data available, and of course, part of that is used and should be used within an investment context. And if you're going to see these numbers now, you have to ask yourself, how can this actually be done? So by 2025, there will be 175 trillion gigabytes of data available. This equals to more than 300 billion years of listening to music. Over the last two decades, the cost of computing actually has gone down by 98%. So it became very cheap. And at the same time, it became much more powerful. So computing power has grown by more than 1,000 times. And also to give you an idea about the momentum behind it, if you think about all the data that's available right now, 90% of that has been created in the last 2 years. And so this this skewness will continue to be so. And that, of course, has to have an impact on investing and on the way how to do business. So investing clearly has become a tech challenge, and then the MDOTM has been doing this for more than 5 years, and then developed really into the leading European player in the field of artificial intelligence investing. And one of the things we found out, and we should be aware of when we go into these discussions, are a few, but they are very, very powerful. One is that AI adapts, and it adapts to market changes much faster than humans can do. On the same token, it's not magic. It cannot foresee the future. It is a tool that needs human supervision to be handled properly. And we always feel that to make sure people trust in it and feel confident in giving their money in a way that it's managed under artificial intelligence, it has to be understandable. However, what AI offers is a very high level of bespokeness, robustness, and it's very reliable as well. So to focus a bit more on the area of our discussion today, artificial intelligence within asset management is also used on the operational side, on the client servicing side, but we want to focus on the investment side. And this can be done particularly in 3 areas. One, of course, this would be managing money, being the sub-advisor, very clearly, manage a portfolio for the sponsor. But it can also be used either for the sponsor or sub-advisor to help with the asset allocation, provide input there, or again, for the sponsor and the sub-advisor in doing analysis of their portfolios, use AI-driven scenarios to help them see how portfolios would actually react in adverse and unforeseen market conditions. So these are the 3 things we want to consider when we talk about the impact artificial intelligence can have on the sub-advisory business. And so with this, Michael, I want to maybe ask you the first question, and if you can maybe talk a bit about what are the incentives and drivers for sponsor, sub-advisory, and client to engage in the sub-advisory relationships, and have you seen the dynamics changing over the last few years?
Yes, thank you, Axel. So I think the sub-advisory business has been a very attractive business because it benefits those 3 parties that participate in it. If you think about, we'll start with the fund sponsor. The fund sponsor historically has built their business around a core competency, and they historically have had very strong distribution networks to go out and market that core competency. But as they've tried to develop new products, they've come to a decision whether they have to build that in-house or can they go out and buy it. And by buying it, I mean, can they find an expert in a specific product or asset class that has a long track record, has a history of success in that, and could they bring that organization onto their platform to manage that portfolio for them? And so for them, it's a the fund sponsor, it's a very quick way to bring in a world-class organization to provide an expertise that the fund sponsor doesn't have themselves. So that's a very attractive proposition. That leads into the second point. The second point is the cost of client acquisition is always more than that of client retention. And to the extent that a fund sponsor can expand the menu of offerings to their client base so that as the investment needs of those clients change and evolve, they have a product to offer them, it's very seamless then to move a client from one product into another. So to have that menu of offerings across their platform is really attractive. And I guess the third thing I would say from a fund sponsor standpoint is increasingly in today's world, if you think about marketable securities, the capacity, there's a lot of overcapacity on the asset manager side as far as providing services in the public securities arena. And so to the extent that a fund sponsor can provide a pretty attractive fee proposition to their clients by going to an asset manager and saying, we can give you access to this distribution, we can give you a significant asset pool, the price points they're able to achieve on new products are really competitive. And so that is something that when you think about, again, going back to that analysis of buying versus building, it becomes really attractive to buy. And so that has evolved, and I think is something that fund sponsors see as really attractive. If you move on to the asset manager in this equation, in most cases, asset managers have very good manufacturing capabilities. So they're very good at producing long-term track records in a specific asset class for a specific portfolio. What they don't historically have had are broad distribution networks. So for them to be able to tap into a fund sponsor's distribution network and have their product marketed really across the world in some situations is a very, very attractive proposition relatively to trying to build that distribution network on their own. The second point, and there's a lot of data around this, when you think about the relationships between the asset manager and the fund sponsor, and if you think about the duration of those relationships, it's interesting because the tenure of those tends to be twice as long almost as that of an institutional account with an asset manager. So there's a lot of due diligence that goes on in the evaluation process. Once that due diligence is completed, there tends to be very strong relationships there. So from an asset manager perspective, they see this as a very attractive long-term proposition to work side by side with a partner for an extended period of time. So that's something that really, really interests them. And I think the third thing is, it's very hard to get positive net client flows these days. There's a lot of options out there. And to the extent that an asset manager can work with a fund sponsor, see a big asset pool that they can participate in, it provides them tremendous growth opportunities. And so for them to see that growth and to be able to participate in it makes this business really attractive. And then finally, when you think about the end client, what does the end client get in this equation? At the end of the day, I really believe that the end client gets a better outcome from an investment performance and risk standpoint. They're actually now able to choose best-in-class products with a fund sponsor platform that maybe historically they've not been able to choose from before. And so that makes the outcomes for them really, really attractive. I think they get investment options at a very competitive price point. And so when you think about kind of the competition that's coming from ETFs for active managers, this is something that you have to take into consideration. So the price point gets really attractive. And then I do believe most clients want to stay in kind of a one-stop shopping network, if you will, with a fund sponsor. So if they can get their needs met by being able to move to different products within one platform, it's much easier and much more convenient than having to move those assets to different platforms and different organizations. So those, to me, are some of the main reasons why it's an attractive opportunity for all three parties involved.
Yeah, thanks. That's very comprehensive. So Tommaso, thinking about that environment, so how would you see where the biggest benefits are in AI-driven strategies compared to more conventional investment approaches?
So, well, obviously, AI does bring a new dimension to the world of investing, mainly because it's not strictly related to the in-house capabilities of the portfolio managers within the firm, the investment firm. But it's rather a technology that can have a greater scalability within the capabilities and the things that it can actually do. First of all, we have to face one of the of the hardest question that we have to answer every day. How complex are the financial market and what is the right positioning? And more than ever, we're facing with the market that it's ever changing. We keep saying that the financial market is a moving bullseye. And this animation here clearly represents that. In the square that you see here are the so-called financial dynamics, things that we can monitor, that we can analyze and make the decision upon them. And we all know that, as time passes by, these things do evolve. Axel, at the very beginning, expressed with a couple of numbers the degree of this increasing complexity. And the risk is that a quantitative model or a traditional model basically stays put looking in the past, whereas an AI model can actually can actually adapt. That's the greatest benefit in terms of what the final client gets and how effectively the portfolio behaves. But we have to understand what's the technology behind. So this animation here, this slide, shows very well how a model that uses artificial intelligence actually works in the first place. So quite in a very simple way, it all starts with the process of data collection. Okay, this is done, of course, by human checking within data set, making sure that everything is coherent. And then basically, rather than having the human actually inputting all the values of the strategy, the human does a different job. The human, rather than doing that, actually has a supervision on this activity, but is the machine that actually focuses on the things that are relevant or not. Okay, this actually allows the system not to be so biased towards the developer that actually coded the software in the first place. And then we get to the most attractive part of AI, which is the adaptability, the concept of not always being the same. Now, we all know that investing changes over time. What might work 2 years from now might not work today, might not would have worked 2 years ago. So how do we face that? We face that by the concept of continuous learning. Basically, the model having a positioning, having developed some functionalities. Basically, as time passes by, gets feedback, both positive and negative from the activity that it's doing, and basically it's able to make sure that it's still relevant to those same market dynamics that we highlighted before. And that's key. That's key for two main aspects. Number one, it allows to be relevant within the dynamics that the portfolio is supposed to catch. Number two, given that it's a model that learns, it can learn different things. And when we talked about before the concept of an open platform with a sponsor willing to have within is offering different products, this makes the case very compelling because it allows the model to learn different dynamics and therefore build different portfolio. Of course, just lastly, but very, very importantly, AI cannot definitely not learn black swan events. Nobody believes that AI can see things that never happened before, but it can adapt very quickly to those changes in the market. And therefore, the benefit associated to this methodology are really highlighted in the next slide, which is basically 4 dimensions, which are all relevant in the concept of sub-advisory. Number one, as we said before, is adaptable. It allows to change as market conditions do move. So it's not something that stays put and loses effectiveness over time. Number two, which is the most important thing, especially when we're talking about a sub-advisory business model, is the concept of understandable and reliable. We all know that ultimately the final client is the one that actually has to buy the product. Now, what AI allows to do compared to traditional model is really look in a more depth way on how market behaves, and therefore is when used properly can actually be a powerful tool to really understand what's going on with the portfolio and transfer that message back to the distribution channel and therefore back to the client, and really keep that healthy loop of reasonable information. It tends to be much less biased than traditional investing because the system has filters and it's not directly a function of the input of either the quant developers or the portfolio management themselves making the decision, which makes the model more robust in general. And then lastly, by learning different dynamics, it can be customizable. And therefore, you can actually go towards what we ultimately believe is the best fit for the client, one portfolio, meaning that really you can train the system to work within a set of parameters that actually fit the need of that specific niche or product that you might have in your catalog.
Very good. So, Michael, what do you think in what area? If you think about a sponsor, the sub-advisory end client, would AI be most appealing? Or maybe another way to look at it, where's the biggest need for improvement?
Yeah, I would say there's a couple things that come to mind, and I'll talk in generalities. I think one of the things that's been really hard for fund sponsors and then asset managers to do is think about multi-asset portfolios. I think when you think about the number of components that are involved in multi-asset portfolios, asset allocation standpoints, it's hard to find a long-term track record of people getting that right on a consistent basis. And so from a portfolio construction standpoint, to the extent that AI could be an input or part of the process that helps with that decision-making because of its capabilities, I think anything that can aid security selection through these different systems could be very, very powerful. So I could see that as one big benefit really across all of the different parties involved. Secondly, I think for portfolios that have a strong fundamental orientation, to think about a complementary exposure to AI would really be interesting from a risk standpoint. So you have strong fundamental orientation where it's really based on security selection. To the extent that you can introduce an AI component into that as a complementary nature to that portfolio, I think the outcomes could be pretty good there. And then the third thing I would say is, any place where you have adequate data. So to the extent that you have a data set that will allow you to make these decisions using AI, you would think the outcomes could be better. So to the extent where we're getting more data in emerging markets, different places where the data sets are becoming more robust, I would think that the ability of AI to positively influence those portfolios could be pretty strong there. So those are some of the things that come to mind initially.
So Tommaso, if you look at your experience talking with sponsors for sub-advisory mandates, what are the services they are most open for?
Well, we see a great demand in multi-asset portfolio and active equities. I think that the active equities is also a function of what's going on the macro standpoint with the rates as they are now. So there is a stronger demand there. But I think that overall, goes back to what Michael said, which is kind of looking at ways to offer something that is not necessarily high correlated with traditional investment methodologies and can actually bring a different point of view. We also have to acknowledge that, how we make decision changes a lot. Human, we tend to be really good when it comes down to strategy, a little bit long-term, making investment where we can, have a longer view. The machine is really good at tactical positioning. So really leveraging what's going on 1 to 3 months and benefit from little inefficiency that there are in the market to have the best positioning. I think that, some of that is a composition of what maybe the clients also have.
Yeah. So there's clearly a lot of interest in that. I think that's one thing we have seen, that everybody wants to talk about it. But also I think there are some concerns. So Michael, from your perspective, what do you think would be the biggest barriers for sponsors to engage with artificial intelligence?
Well, I think the first barrier is it's relatively new. And so to see, for a sponsor to think about evaluating a track record, they're pretty short track records. And so being new, how do you overcome the fact that you don't have a long history of a return pattern generated by an AI-driven model? So I think that's one thing that fund sponsors will have to reconcile is it's new. There's a bit of a leap of faith. Do I understand kind of the philosophy and process behind it so that I have confidence in it going forward? I think that there's, I've read recently regarding AI that there are some concerns about the fact that a lot of the data gets analyzed from the internet, and that data gets inputted by humans. Are there human biases that get into the data? I don't know where this goes, but I think it is a concern that people have is, is there an inherent bias that somehow gets reflected in the data, and how do we reconcile that human bias? And then I think the third thing, and this may be more just from a standpoint of, human ability to reconcile change, during periods of uncertainty, I think there's a confidence in human judgment that if you have a period of uncertainty or if you have an event that occurs, will AI be able to respond to that in a way that gives people confidence, maybe as a human would? You've seen some of these things with AI-driven vehicles. You know, how have they responded to some of the challenges? And I think there's a real concern out there. Will AI be able to exercise a decision based on a judgment through its process that provides a good outcome? Those would be some of the things that I could think of.
That's an interesting segue, Tomas. If you respond to these 2 points about the bias from data coming to the internet and how models reacted to unforeseen circumstances.
Yeah, so like the first one is a well-known concept in the industry. It's called garbage in, garbage out. If you have like poor quality data, that's going to affect everything. That's not something necessarily for the machine, but also as for human. If we think about what's going on with the pandemic, when we didn't have like good quality data and still we don't have necessarily the best data, we're making very poor decisions. So actually, often good systems are able to detect when coded properly, to detect if there are anomalies or outliers in the data to really spot them. So it could be seen actually as an advantage to a certain degree. And when it comes down to really addressing the concept of how to prove also a young track record, which is always a problem. As you said, really looking at most recent event and how it behaved, that's really helpful, and see how it moves. But at the same time, it's much easier if you're able to really transfer the reason and how the machine is making the decision. And that's something that if you have a strong scientific background and a strong scientific approach, it can really have a compelling case, because you can really, going back to that understandable statement I made before, you can really show that it's coherent to what the system is supposed to do. I think that it's what helps to win them ultimately, both the deal and the trust of the client.
I agree. I think that's something we have seen quite a bit too, when we can show to clients that the model is actually learning and how it applies that. So when we look back 1 year when markets dropped so significantly, the model suddenly did something it has never done before, which saved clients a lot of money. But I think that's a very valid point. Tomas, also maybe to touching on the third point that Michael mentioned about short track records. But on the other hand, if a sponsor finds a need for a product, how long would it take to fill a gap like that, to come up with a new strategy for a client?
Well, it really depends on the architecture and the system you've built behind. So it really goes down to that. If it's well oiled, it would take between 1 to 3 weeks, I would say, depending if it's really far-fetched, where you have to understand the dynamics and understand how to transfer that to the machine to learn it. Or if it's like something more straightforward, which is just some variation in what the system is already capable of doing. So it's fairly quickly. It's never and will never be, at least for the next near future, just a click of the mouse, because these systems, they do need to be monitored, and they need to be trained properly to really add value where they're supposed to.
So, Michael, in your opinion, will AI-driven investing become something similar or as mainstream as ESG is now?
Well, it's interesting when you think about ESG. I think ESG has a political and moral tailwind behind it that is giving it a lot of interest and efficacy across the world. And I think that, ESG is something that clearly people are embracing now and seen as something that's really important. So I don't know if AI will have the same thing. That being said, I do think there's a huge intellectual curiosity in AI, and I think when you think about those 3 steps of the value chain that we talked about from a fund sponsor standpoint, to be able to bring something that's very different to the client that talks about a process or a methodology that can help with risk control, can help with performance returns. I think this is a really attractive proposition. So I do think that the interest is there and it's building. I mean, if you think about just technology broadly, I mean, all the asset managers are trying to do more in technology, both from a standpoint of portfolio management, as well as serving their clients. The end user is utilizing technology more in order to make changes in their portfolios to view and evaluate their portfolios. So it's becoming ever present. And so to the extent that there's a tailwind there just because of the way the business and society is evolving, I do think there's a strong tailwind there. So I would say that, yes, you're going to see more of this. And I think, you get one large sponsor to adopt it and to go out and have some success with it. I think it's a very copycat industry in many respects. If one sponsor shows success, I think a lot of other sponsors will get in line to do more work there and possibly incorporate some of those in their own offerings to clients.
Okay.
If I may add on that, I think that there are few things that we have to consider. What you say, Michael, is absolutely right. But at the same time, we have to think that now making any decision without a solid, a statistical basis, data basis, point of view, it would be seen as, not really relevant. Imagine a doctor coming in and just touching you with a finger and say, you need surgery here. You would expect the system to have, data, a picture, X-rays, and even more of that. So looking 5 to 10 years from now, thinking that we could make investment decision without something behind our back to really justify thoroughly the position that we're getting, I think that this could be the driver in the change, as it is for the ESG, which is absolutely a really sound push that we're getting from the regulator in the first place and from the market as well. It will have the same feeling that everything has to be based on solid data and data interpretation. And this kind of leads me to the second thing that I wanted to say, which is we have to rethink what AI is. People think that AI, because we've seen so many sci-fi movie, we think that AI is this crazy things comes along, it makes a crazy intelligent decision. It's not really the case. We have to see at AI just as we look at statistics. A long time ago. But it's just statistics on steroids. It's a system that allows to work better within complex data. And ultimately, the world is getting more complex. So that's where we see that the shift might happen.
Yeah, I would just add on to that. I mean, at the end of the day, everybody's looking for an edge in order to be able to provide better performance in a risk-controlled environment. And to the extent that AI can be a tool to provide that edge so that you do get better, I think there'll be a lot of interest in it. I do think that will be something that people will want to know more about, they'll want to see implemented, and I do think you'll see greater adoption.
So this may be a good segue to open up for questions from the audience as well. So we already have a few in the Q&A section, but please add that, and I just will try to go through them as much as we can. So the first one is from Ricardo. He is asking, Tommaso, would you intervene and change the portfolio in case of a different feeling or deeper knowledge?
Like the models are constantly monitored. Of course, we would never leave the model running by itself, meaning that with no human supervision, because that would be just wrong. Like also leaving human going along without any supervision. Any major decision are always going through committees and checks, sanity checks whatsoever. So that monitor activity makes sure that the model is relevant. Of course, the model do need to be updated. And this kind of goes back to what we were saying just a second ago on what's the future, what's for the future. We have to think that, what we're seeing now, it's not what we will be 5 years from now, 10 years from now. Because technology can increase the value that it brings. It can actually evolve and become better. Not just the system becomes better, but we're constantly, throwing in 70 to 75% of our yearly costs into and expenses into R&D. So effectively, this system will get better. So of course, the intervention happens to make the model be more precise, have new release. So it's a very sound and natural, constant R&D effort. So the real question is, what will it look 5 to 10 years from now? Because that's where we're after. We do see that it adds a lot of value today, but if we keep advancing with the same degree of improvements that we're experiencing, really the picture 5 to 10 years from now looks very, very, very nice.
Good, thank you. There's one from Michael, and that's kind of interesting. Artificial intelligence in conjunction with regulation. And there's so much, if I paraphrase the question, there's a lot of uncertainty out there and concern out there. Do you think that there will be something like safety standards for data transparency within regulation?
Yeah, that's an unknown. And I think it's a really good question, to the extent that we don't really know where the regulatory environment will go with this yet. And so I do think that it's going to be an important evaluation piece and something that will have to be considered. But right now it's unknown. I would suspect that that it'll be more regulation than not to start off with, until people get more comfortable with this, to protect the end users, if you will. But it's a really good question, and something that I don't have a good answer for, quite frankly.
Thanks. I think that's hard to, it's a good question, very hard to answer on that section, like watch that space. So then we have another question from Brian, just read that out. He says that the adoption of the AI in a very conservative industry like finance is hampered by the A in AI, so the artificial. Unfortunately, the AI moniker is probably here to stay. Can you provide a real life example where AI technology has improved the results of either an asset manager or plan sponsor? Tommaso, that's for you.
Yeah, absolutely. We have roughly $500 million running with a sub-advisory business model on our models. And we feel that, where the model adds value is multi-asset portfolios. When it gets down to, it's not just, of course, 3 asset classes. It gets down to a much greater granularity, because that's, what a system likes to see, complexity, or single equity portfolio. Where we don't see yet the value is in the single bonds space. Because in the single bond space, the execution kind of puts a limit on where the predictability and the predictivity is actually adding any value. So that's where we see the value. Of course, to actually show performance, that would be our clients to do that, because that's how the sub-advisory business model works ultimately.
There's another one for you, Tommaso. So do you see potential in freely available data from the internet to build up an AI-based investment portfolio application?
Yes and no. I mean, yes, in the future, because what has happened over the last 5-6 years is that we've seen a full democratization of information. Everything is available at the click of a mouse in a minute. But most of this information is really useless. So it's always really important to ask ourselves what is the driver of any movement that we're experiencing in the price. One quick example would be the case of GameStop. Everybody is talking about that, so let's jump on it. This Reddit, okay? Of course, we knew Reddit since long ago. Is the 4th most viewed website. So it really attracts a lot of people. But you have to think yourself, if you want to have a system that processes all the information contained in the 4th largest website in the world, constantly, daily, scrolling through chats, understanding if there any causality in what's happening with the chats, with the market, you have to build experience out of that. The case with GameStop is really simple. What if you would just have, monitor the short interest? You go on Bloomberg, you type SE short interest, you have the full list of short interest. Then you monitor the volumes, you monitor the time to cover, how long it takes to cover that short interest. And if that things change a little bit, you have an alert that gets triggered. So working with structured data, even though they're boring, they're out there, everyone to see, it's not always less informative than just spending a lot of research to finding something that might not even be there. So going forward, we do think that additional data might bring value, but we have to work very, very carefully, put the effort where we feel that there is actually added value. And it's not usually in the large numbers. It's usually data that have gone through the process of being out there for a little bit and start to normalize. When it's normalized, then it's useful to get within a process to make investment decision.
Thank you. So we have time for one more question, and that goes to Michael. It's kind of twofold. Should AI be seen as its distinct investment style, like quantitative investing, fundamental investing? And then also, what do you think the role of the consultants is in establishing that as its own style?
Yes, it's a good question. I do think AI is a little bit different than quantitative, so I could make the case that it is its own investment style. I think the dynamic nature of AI makes it somewhat different from a systematic or quantitative approach. And so for me, I think, it could encapsulate its own category, if you will. I think the natural tendency would be to try and lump it with a quantitative or systematic, but I do think it's very different from that. So I would say that it would be its own category. And as far as the consultants are concerned, I think initially they probably would put it into more of the systematic, but as they learned more about it and they understood it better, I could see them creating a category that was a specific AI category.
Thank you. So there's just one more question coming in. Let's see if we can address that. So maybe, Tommaso, okay, we use that as our last question. Don't you feel exchanges are scrutinizing this type of business to extract additional fees from this type of business?
I don't know about that. In reality, when we talk about the sub-advisory business model, it's ultimately counterintuitive at the very beginning, because you're thinking you're adding more layer, more people are joining to bring the final people, more companies ultimately are needed to join and to partner to bring the final product to the client. But actually, it actually creates a different economy of scale along the supply chain, because sub-advisory ultimately actually allows to lower the fees to the final client, because it allows to have its own economy of scale. For example, we as a sub-advisor, we don't need to have the full distribution channel. We all know how expensive is that. We don't have to have the right people to do it. We don't have to have that hurdle. We have to have the hurdle of learning how to train this model. And thus we have 30 people doing that, okay? On the company who has distribution doesn't need to have the 30 people we have. He can rely on his own activity, the relationship with the client, knowing the market, knowing what the clients ultimately want, and point us in the right direction. So the final client gets the best of both. And of course, we can do this activity to scale with other companies as the same distributor, the same sponsor can do himself. So it actually is counterintuitive at the very beginning, but then when the business starts hitting, it's actually makes a lot of sense.
Right. So there's one more interesting angle, and we really have to close after that. So if everybody would do AI-driven investment, so what would be the end game? Would there be any alpha left?
Yeah, if
you look like the quant meltdown in 2007, everybody was quant being super uncorrelated, and then it all went south. So would that happen with AI as well?
Look, the market, then I'll leave Michael to kind of conclude, but the market is so big, and there's so competition. We have to think that if we would be like that, there would be no market. So take BlackRock, the largest player in the planet. They have inside hundreds of different teams competing within themselves. So it would never be a one-player game. It would always be different player, multiple player trying to get that edge. What it will happen actually is something positive, we believe, because all this increasing efficiency and all this system able to catch the smallest signal hidden in noise will make the system overall much more stable, which is the same thing that's happening now. Investing in stock market now, it's way more safer than investing in the 70s or 60s. Information is much more transparent. There are many more active players trying to really balance the system out. So ultimately, it will be tougher to extrapolate alpha. Of course, it will need much more technology, but it will always be there a possibility to do so.
Michael, do you want to add anything on
Yeah,
that?
I agree with what Tommaso said. I think that, you could theoretically say that if everything was that efficient, that the alpha opportunity gets arbitraged away. I think they've been saying that for years across, the spectrum of investment management, with the evolution of the industry. I don't believe that. I think there's always going to be certain dislocations or things that can be taken advantage of. The amount of alpha may decline, but I do think there's still going to be alpha propositions out there, and it doesn't go away. So I don't think we ever get to 100% fully efficient market where there's no alpha left. So I guess I'm not in that camp.
Very good. So I think that's a nice finishing statement. Will make all active asset managers very happy to hear that. Well, so with this, I want to thank everybody who participated. We had a great audience today. Michael, thank you very much again for taking the time.
Thank you for having me.
Very insightful. If anybody has any questions, I will put up some contact details. Feel free to contact us. I know that we couldn't answer all the questions that were asked to us. We're happy to do that afterwards. So with this, thank you very much and enjoy the rest of your day. Bye-bye.
Thanks a lot to everyone. Bye-bye.
Thank you. Bye-bye.